if you want to breathe some life into that, the psychology of the buyer is really where it gets down to. And it seems that it's very similar in pattern behavior with what's happening on Amazon and what's now happening on TikTok Shop.
And I want a good show, damn it. Ready for a good show?
Doing awesome, yeah. I'm excited to talk to you, Angie. Thank you for having me.
Yes!
I've always been doing big into archery, and my dad said, hey, you guys want to start an archery store? Because that's how it was.
Andrew, yes, of course, let's do this together.
Hello, everyone. Welcome to another episode of the Ecommerce Show. Hello, everyone, and welcome to another episode of the Ecommerce Show. I'm your host, Andrew Maff, and today I am joined by Neil Twa. He is a co-founder at Voltage Holdings. Neil, how are you doing? You ready for a good show here?
Yeah, man, let's rock it out. I'm happy to be here.
Yes. Super excited to have you on the show. Even in the first very couple minutes of us just kind of BSing before we started this thing, you hit a sweet spot with me on Omnichannel that I'm very excited to get into because not a lot of people talk about that.
They should be.
I completely agree. And we're going to make sure that they do right after this episode. So let's do the usual. Let's pretend that no one knows who you are. I'd love to hear a little bit more about your background and then obviously more about Voltage, and we're going to take it from there. Okay.
Well, now I keep it boring and keep it pretty succinct so we can get to the meat of this stuff. But in essence, I've been in e-com and around business and the internet since it came online, either from the technical side of building them and getting through college and realizing that I didn't want to live in a van down by the river because I went to school on a full ride music scholarship. And instead, I jumped over to the internet of all things. And really, you couldn't get taught how to do that. So I jumped in the corporate world and we kind of learned along the way. Got to be a part of the first PCS division for mobile launch of the first cell phone and held the team together that held all the website documents that all the reps used. We built that into a knowledge management system, and that grew to the business that became Sprint. And so that was like 5,000. I was a 5,000 employee when I started. Got hired there full time after being a developer contractor, and then moved into their knowledge management side. We developed, and then literally after 5 years, that company had grown to 80,000 employees and 25,000 reps. So we saw that whole mobile thing explode from the inside out, which was crazy. But we had to develop technologies, and so machine language learning, natural knowledge management, and the growth of that just no longer support web pages. So we started to work with companies to develop that. And then IBM picked me up and said, hey, you're doing really great with that. Come do that with the rest of our clients. And so until 2007, I was doing that with them into all kinds of major companies in the mobile and customer and division and telcos and high tech and even oil and gas. And so then I left in 2007 and set on my own series of companies. So I started a management consulting division and did really well with that until it failed horribly and had to reinvent myself and went through a business bankruptcy due to some financial conditions. I got a little heavily too leveraged. I learned a really tough lesson about people and who to trust and who not to trust with money. And so that was a real fun lesson. And so in the process, I knew what I could do to make money. And so I went back to that, which was lead generation and developing traffic and online for cost per lead, cost per click, affiliate marketing and mobile application affiliate marketing. Did very well with that and realized I needed to own the whole offer from end to end. I wasn't just good at the traffic. I needed to develop a brand and not just make more people money, because during that process, I helped some companies raise some good money, millions of dollars for their business based on our lead generation tactics. And so I started owning the physical product world. Long story short, that led me to Amazon in around 2012. And I said, hey, there's got to be something here. This is just another lead generation engine. It's fascinating how they're building logistics and last mile to the customer into this whole platform, and kind of fell in love with the concept and started launching brands. And in about little less than 3 years, we had our first 7-figure business on Amazon. And then from there, it was family and friends and other people were like, hey, show us what you're doing. We're trying to get going. We want to know. And so we taught a few people how to do that and kind of retired that idea in 2016 and just kept building the businesses, building the infrastructure, had a few clients on the side that we helped with. And then I got approached to kind of, quote unquote, come out of the consulting retirement that I was in 2019, because I got approached by a friend who said there's a hedge fund that wants to put money into this thing called Amazon aggregators. And I'm like, what the heck is that? So we went on a research binge and discovered there was, all this money that wanted to move into acquiring Amazon companies. It was a maturation moment. It had come from a lot of growth in 2020 that was being seen, in this world of e-com, especially because so many people couldn't go get stuff anymore. And it was growing extremely fast, and people were wanting to spend money on buying these companies and really ride that wave. And we raised between a couple of home offices, we had verbal capital of between 50 and 100 million between two offices. We were kind of settling closer to the 100 because we wanted to buy about 53 companies, and we were going to become a full-fledged cold voltage portfolio as an aggregator. And so we got to the end of 2021, around November, my partner comes to me and he says, hey, all this data now, we can see all this stuff for the last couple of years. And he's like, we can't do this. And I'm like, we can't what? He goes, we can't do this. And I'm like, well, you have to show me, because I spent 2 years developing this capital, this arrangement, this getting this whole thing to market. And you're telling me we can't do it? And he's like, no, man, you got to see the numbers. And so I went into the numbers with him, and basically they were buying up market share of up to 40% above asking price, right? Just to capture that market. They would take a business that might be worth $1 million and offer 40% more for it to grab that business away from someone else who would purchase. They were just in full on acquisition mode, dumping something like $1 billion in capital into this whole thing. And we're like, we can't do that. Everything we're going to get is overpriced. Everything that's worth some value is going to be overpriced. We got to wait this out. So we paused. Long story short, we paused. We went back to building, and that drove up a consulting division again, because I had all these people who were like, well, we were going to do this. Now what do we do? And like, well, let me just teach you how to do it. So I started consulting with more and more people on how to get going with this, kind of the roots of everything I've ever done. And long story short, the market is back to buying position. The products have right-sized, the brands have right-sized now through capitulation. You're seeing it in the market of aggregators, consolidation in the market, and as well as bankruptcies, now restructuring debt and changing, that whole market sort of quote unquote imploded just a little bit. And now it's sort of right-sized the purchasing power. The buyer is now in control. Again, the seller's deals and the seller financing are now much greater in terms of options and opportunities. So this year we're going back into buying mode, but on a smaller pace and with a venture capital firm backed by veterans. So we're going to put veteran operators in place. That's part of the requirement.
Oh, nice.
It's called Patriot Capital. And so we're going to go in and bring in veterans and bring them into the business model, teach them how to do that. And in 60 months, have built up a war chest with them to be able to buy that business back from us. So we're looking for 5 companies this year to start doing that process. And we've been working through the process right now on due diligence on a couple companies and hoping we can get a trigger pulled this quarter or next quarter and really try to achieve that metric. So now we're into the M&A side, not just the business development and growing. We do operate. We've got about 200 something clients we work with in the business and development on all scales, from beginning to growth to multi-channel, omnichannel, which has been big and should be big for a lot of people this year. And that's a really long answer to your short little question, but there's a whole lot to unpack in all these things. And I'll stop for a second and kind of pause for anybody who's still listening. I'll pause for a second.
It's so interesting. So what's your stance on the aggregator side, right? Because it's a very... it's a very interesting topic. A lot of people, you get like the Thrasios of the year of the world that kind of more or less didn't work out as much as everyone kind of thought was going to happen. And obviously that caused a big shakeup of just the industry as a whole was just talking about that. They still are. What's your theories on, that kind of aggregator space?
So I had a article contributor for the digital side of CNBC reach out and is writing an article on that exact topic, as a matter of fact. And I just spoke with her yesterday. So it's kind of fresh on my mind. And here's the outcome. The aggregator space is not dead. It is going to be solidified. It is a business and opportunity, no doubt about it. But it was a run to push a lot of money, I think, into fear through buying and acquisition, right? And so just capture and gain everything. That's not really the smartest strategy. What they honestly fell under the weight of was having 100 to 150 job recs open to try to get people to run the more complex parts of this operation, which take a lot of time to develop the strength and knowledge to do. And especially with a complex channel like Amazon is now. So at the end of the day, they couldn't find the intellectual property necessary and the capital property to get it done correctly, because anybody who might have had that strength and would make $250 a year or more in net income off of their business isn't going to go take a job. So some of these job recs were between $200,000 and $300,000, and they weren't filling it with anybody who knew what they were doing. They were putting warm bodies in seats and couldn't find enough. So they found operational controls that were not strong enough. They bought properties that could not be sustainable. And so what's occurring now is twofold. The CFOs are like, hey, we got to get below this bottom line and get profitable. So everything below this bottom line has to be dumped back to the market, right? If we can sell it, great. We go back to the original person who sold it to us and say, hey, do you want to buy it back for pennies on the dollar? Like, we'll get rid of those assets. And that's what's happening right now. So off market, there are deals being done to basically offload that inventory, quote unquote. Some of those brands are not worth turnaround because they destroyed them in the algorithm of Amazon and their seller accounts, and you just simply won't store it. You'll have to start over. but it's creating kind of a hole in the market, which is interesting, right? Because a lot of those businesses are going to get shut down. A lot of those products are going to come offline because they weren't profitable, but it's going to make them more profitable once they do this. So it was either an opportunity, a crime of opportunity. In other words, it was a strategy. Okay. It was a business strategy to go in and buy up everything they could, knowing that at some point they were going to restructure this debt, maybe even intentionally file a business bankruptcy as a strategy, or consolidate to other parties, sell off these assets or whatever's necessary. Or they simply just were ignorant in their ability to run. They thought they had the intellectual property and capital necessary to get it done, and really discovered that they couldn't get it done. But it's in either instance, the outcome is sort of still the same. What you've got is a base of aggregators that will become stronger. They will become the competitive nature. And what you're going to find is there going to be a lot of opportunity, like Voltage, to move in and around them in more of a speedboat fashion than their giant Titanic, right?
Yeah.
And with that, I would analogize, they may become the Walmarts of this model, these stronger, but there's Trader Joe's out there. And Trader Joe's actually make more profit per unit than Walmart does, more profit per store. So I'd prefer to be a Trader Joe's. And so that's kind of how we're looking at it now. So there's still opportunity to kind of come around their wake and maybe not raise the billions in capital and come up with all those complexities, and still have a really great business and a really great amount of products. But it also, the third last final point is that it's going to pull a lot of stuff out of the market. With Amazon's fees, and now they're trying to pause some of their fees and changing, and a lot of people are complaining about that channel, while TikTok is raising their fees and moving towards this year to move fees up by July to 8%. It's currently 6%. They're still not going to be at the average 15% for Amazon, so that still creates good opportunity. There's a lot of shift coming this year, right? There's a lot of opportunity coming this year. And there are going to be a lot of sellers falling out of those platforms who just simply weren't strong enough, did not have the operations, and will not have the capital to sustain.
Yeah.
So there's going to be a lot of that consolidation and stuff. And frankly, opportunity. Blood in the streets, right? But a lot of opportunity, no doubt.
Yeah. So I know, we talked a little bit about this like right before the episode. You've dropped a couple nuggets here and there. And now, like, I think we should get into this. The omni-channel side, right? Oh, I preach this like it is my job, so I preach this a lot. So like the what's your stance on it in terms of when you're looking at businesses that you're potentially going to acquire, or when you're looking at businesses when you're helping them from a consultant standpoint, like what's your stance on where these sellers should be, and versus the ones that are just on Amazon or just on some other marketplace?
There's a couple of parallels running along with this. Like a couple of years ago, user-generated content was really making a run at it from the creative side of any brand, product, service, even on Amazon, etc. And so Business Insider said this is the year of the creator, which means it's now the year to shift up the way you spend, think about money, and the way you move your customer around what we call the halo effect, multiple channels of opportunity to touch them. And so for this year, I've said this for the last 3 to 5 years, but I'm saying it really conservatively for those who are, listening to me right now. This is the year of omnichannel. You can no longer simply say my Amazon FBA is a business. It is simply a sales channel. From there, you must move omnichannel. Shopify, wholesale, retail, some other division. As I was joking earlier, you could put it, in boxes and stick it out in front of QVC. You need additional sales channels. All right, TikTok Shops is another opportunity at this point that's growing very fast, even though it's extremely Wild West. And they are still trying to figure out their way around this. And there are really about 6 categories that are the strongest on that platform. And if you don't fall into them, you're going to fall out. And if you're selling anything above probably $60 to $80 right now, it isn't necessarily going to be a great fit for that market, not on volume. So what we're seeing is if you've got products on Amazon in the $20 to $35 range, they could be on TikTok Shop. Most likely they should be. The halo effect for a couple of brands we've tracked internally and watched them grow internally as we consulted. With Tammy's brand, for example, she's selling out by noon every day. And she had a product that's been on Amazon for 10 years, and she opened it up in the TikTok Shop, and now she sells out every day faster than she can stock inventory. She had a couple of videos that just popped off, and all of a sudden it's now a hyper growth problem. So people are kind of like, well, they would love to go viral and I want to have all that. And then it's like, well, now you need stock, you need inventory. You got to push that hard. A friend of mine, Zane, I just had him on the podcast last week, and he's moved omnichannel from Amazon to TikTok Shop and is doing well over 200,000 a month now. And he was explaining some of the concerns and challenges he's had with having that hypergrowth problem of trying to keep stock and inventory in place without you ended up with, violations of delivery times and other violations the platform's tracking against him pretty fast, simply because he can't navigate it as fast as it's going. And TikTok itself is still trying to figure some of it out. So they're changing stuff constantly, but it doesn't mean you shouldn't try it. It doesn't mean you shouldn't be testing it. It means if you're an Amazon brand, you should be on TikTok shops due to the SEO and the halo effect crossover. With Tammy's, it was up to 25% crossover. Okay. When she got about 8x on her TikTok shops, she was seeing 2 to 3x on her Amazon store. Okay. So if you want to breathe some life into that, the psychology of the buyer is really where it gets down to. And it seems that it's very similar in pattern behavior with what's happening on Amazon and what's now happening on TikTok shop. There's a definite effort or a concerted effort to track that more. But what we're seeing initially is that the data is showing the growing amount of 30, 40, 50, 60-year-old people is on TikTok, the largest growing demographic. And they're also the largest buying demographic on Amazon. And so if they're hitting TikTok shop, they're familiar with that enough to buy on there, or up to 25% of them are going backwards to Amazon. They're not going to the .com. Let's make sure we understand what's happening. They're not falling over to like Shopify, okay? But from Shopify, you can follow them back to, say, TikTok shop, but Amazon has to be a component. It's what we call demand capture, right? So at the end of the day, Amazon's now a demand capture platform. TikTok is becoming your demand discovery platform, and Shopify is becoming an audience conversation platform, meaning that's where I could touch them initially and then track them backwards to other locations if I didn't make first acquisition on that platform. And with that, you get a whole kind of halo effect going on, right?
Yeah.
So there's that real opportunity now to look at where am I going and where can I move faster? Now, if you're thinking TikTok shop is a great opportunity to begin with, you're going to have some challenges. Unless you understand 3PL, logistics, warehousing, freight management, and sourcing products at that level, TikTok shop is going to be a challenge because they don't have their own delivery system yet. It is now rumored and in conversation with a few people behind the scenes that Fulfilled by TikTok, or FBT, is coming. And that is going to be their attempt to try to become a Trader Joe challenger against Amazon by helping the product be delivered in 2 days or less. Because right now, most of the major violations for sellers are coming from that 2-day delivery requirement that TikTok has, and people just aren't making it. They're not making it, not because they didn't get the product shipped, because UPS is not making it, or U.S. Postal Service is not making it in time.
Yeah.
And they don't have the same leniency right now because they haven't set the rules up right that Amazon does for slight variation and changes of the delivery pattern of the requirement for USPS to get your product there or UPS to get it there. And so now they're dinging your account with violations, even though you had no control over it.
Yeah. So, you're preaching to the choir right now. Like I firmly believe like Amazon is an amazing customer acquisition channel. It's a great place for, people that are actively looking for something for you to be. It makes a ton of sense, but it's getting so expensive. And so it's pricing people out in terms of having that be, as you said, like I have just an Amazon business.
It certainly can. And my only objection to that would be to clarify that for us, we won't move a product for less than $50 retail into Amazon. We haven't done that for more than 5 years. It was a shift away from products we had in the $10, $15, $30, $35, $40 range and moved them all up and elevated those brands and products, new product launches, into the $50 to $150 range. Okay.
Yeah.
So with that on Amazon, the costs are not the problem. And because with the inventory and just-in-time way we do it, our costs have actually gone down with Amazon's changes, not up. So the types of businesses that actually have gone up are sub $30 products. They're not managing their inventory very strong. They'll just take a bunch of inventory and throw it into Amazon and wait. And now Amazon's saying we can't do that anymore because we got a lot of problems with a lot of wholesale, online arbitrage, and a lot of these product flipping business models that have caused a ton of returns, a ton of leftover stock and inventory in their warehouse. And their answer sort of to that was kind of a carte blanche fee structure. And with that fee structure change, which they've now paused as of yesterday temporarily because of the amount of people that screamed bloody murder everywhere, that they were going to go out of business if Amazon did this, it made a big bad ripple in the market. And so they paused the fees. But what it basically was, you're going to get feed if you put the product in wrong with the wrong amount. And if you take and don't have enough product in at that amount, you're going to have to be smarter with your just-in-time inventory. So a lot of the complaints you're seeing are a lot of people who simply weren't managing the operations of their business very strong, and they're suffering from it. They had low-priced products with high volume, which is revenue-based. That's a vanity metric. It was amount of units I moved per day. That's a vanity metric. And they were not focused on profitability first. Okay. So profitability will get you there at $50 to $150 in retail price point. It's a whole different set of products, what we call our tier 2 avatar, right? Tier 2, tier 3 avatar. And that avatar is now translating backwards into TikTok shop. So soon we're going to see that elevation of products in TikTok shop off of the Me Too 2014 products from Amazon. which have been out there a lot right now, into products and brands that are going to expand in that environment as it matures. This is the same way it happened in 2012 to 2014 on Amazon. It's going to happen in TikTok, which means there's a ton of opportunity out there. So to your point, and not to be contradictory, but it's where you price the product and where the value of your brand brings profit, then you will see some of those challenges for Amazon's channel be resolved through the way you operate the business, frankly.
Yeah. How are you looking at that from a marketing perspective? Like, now you've got all these different channels. You have probably your own website on Shopify. You've got TikTok Shop. You've got all the different social channels. You have Amazon, Walmart, eBay, Chewy, like all these different areas. What's your stance on how it should be marketed? Because I know a lot of these channels are starting to kind of work together. Like you've got Buy with that's getting really big from a perspective on any D2C site for Shopify, WooCommerce, stuff.
Yeah,
they're kind of working together a little bit. Like, what's your stance on how to approach that from a marketing perspective on where you're driving your customer?
Well, it's twofold. First, if the marketing objective is an activity of sales, which it is, and sales do become an opportunity, you've got logistical problems to identify there. If you know your customer avatar very well from your Amazon business side, let's say you've established its brand, you've got multi-products moving, you're doing 6 figures on Amazon. At that point, you've got a pretty good handle on who your avatar is, right? So from a marketing perspective, you're going to translate that same similar language, image, graphics, in-use photos, et cetera, over to something like TikTok Shop and start translating it through video format. You should be able to do that if you're a good brand marketer. And that way, again, with the psychology of the buyer being very similar, if they transition back to Amazon and find you, okay, and then they go back to TikTok, they may decide which channel to buy you on. And that's just an opportunity of your marketing effort. Now on TikTok, there's something very different that can occur that's much more difficult to do on Amazon. And that is this whole affiliate creator system they've built in. With the affiliate creator system they built into TikTok, you can now get your product in front of thousands of creators who are interested in making a commission on your product. And then for that, they'll make a video. Now, the system and point-based system of TikTok's violation system is pretty cool because it requires them to leave a video or they get a violation. So when I give out 100 units of samples on TikTok, I'm going to get 100 videos.
Yeah.
It's very powerful. It's very hard to track that in many other mechanisms, right?
Oh, yeah. It's a nightmare.
It's a nightmare. And it was a nightmare for Instagram, even though they tried to do it, but they failed miserably at connecting the creator with the product developer. And that's where TikTok really became an opportunity, is putting brand owner in front of, product creator in a sync system that tracks both of them all the way through the process. And both receive a mutual benefit when they work together properly. So that means the creator who has a video that pops off and does well with a brand owner who will deliver the product and can deliver correctly, they'll go back and make more videos because they're going to make a lot more money. Yeah. So you see in some of these brands that are doing it really well, the snacks brands, the candy brands. One of my former clients, when we got them started on Amazon years ago, they transitioned their Amazon business into a couple of new places. One of them was candy. And from candy, they launched a candy shop on TikTok and is one of the largest candy shops now. On TikTok. And so they've been able to deliver. They've gotten more than 5,000 square foot of warehouse and 20 people cranking as fast as they can to deliver these candies into the market because people are just blowing it up. And they got a lot of creators making videos who are doing really great with them in that process. So then that leads to where does the demand marketing, the more direct marketing, the CPA or CAC come in, and you can do, shop ads on TikTok Shop. For those of you who are not aware, there are certain limitations because there's not the same level of inventory. If you're spending $10,000 a day on Meta, you cannot spend $10,000 a day on TikTok right now. There's just not the level of inventory, and the system doesn't appear to be as mature in its ability to spread out and find new niches and new customer segments of data yet. But I'm sure it's coming because it's really a unique kind of engine they built inside of this platform. But you can spend, and I have that friend I mentioned earlier, spend about $1,000 to $2,000 a day on his shop, making basically about 20% of his revenue. From that, the other 80% is coming from affiliates, right? Mm-hmm. And with their system set up in terms of the ability to acquire those customers, TikTok's actually helping you acquire it. In the same way that Amazon is sending it out to blast, they're putting it onto media, they're spreading it across their Prime channels now with sponsored ads and sponsored brands, even sponsored TV brands now from Amazon, which is cool. Because if you're on Freevee or something and watching a show and it's an outdoor show, they'll put you an outdoor brand in front of you, right? And that's pretty cool how you can literally market on TV now. And so the effect of that is that with TikTok, their demand and shop driven aspect is giving people the ability to pull more creator than cost per acquisition through marketing efforts. But here's something that most people don't understand yet, and we're tracking this. So I will give you the big air quotes as to though this is not completely validated yet. But there's this thing that happens on Amazon, which is really cool, and that is organic sales through SEO and search engine. I think we kind of all know that, right? We all know that somewhere around 2015, they changed the algorithm to allow your paid ads to affect your ranking. Okay. Yeah. So that if you do well on the paid ads, you'll lift up your organic ranking. It's a pretty cool. Not many platforms online actually do that very well. Etsy kind of does it, but nobody else does it that well.
Yeah.
We're watching a very similar occurrence on TikTok right now. It's kind of fascinating, where paid media is lifting up the virality and the engine and awareness of that. Even if the customer's not buying it, creators are seeing it, which is giving them more interest in coming over and being an affiliate creator. So there's a little halo effect of rankability, SEO, and affiliate creator that's coming from the paid traffic from that side. If you're over on like Shopify doing it, you're still going to get the same spillover. If you're pattern interrupt ads on Meta or over there, they're going to fall back to the .com, or now they're going to go search Amazon, and now they're going to look like a percentage of them are starting to search TikTok too. So if you're running demand acquisition, the challenge then becomes tracking them backwards to determine that, well, if I spend X amount every month, but I see a rise on Amazon, I have to be able to track that if I didn't see equal or greater than rise on my Shopify store or my TikTok shop, because demand capture is going back to Amazon. But if you understand all that, then you understand you need to track it and measure it correctly, or you'll never see the results from it. So from a customer acquisition,
everything else.
I mean, but costs are all gone up. CPC on Amazon's above $1.45 cost per click. Okay, which means you've got to have the profit in your product. You have to understand your average cost of sale correctly. We track more total average cost of sale tacos, and we look at 90-day CLTVs and LTVs for those products. So I know if I'm going to buy customer demand, I know that the positive implication of that is an organic search result if done correctly. So therefore, I'm willing to buy more traffic than others are. I'm willing to let the ACoS go higher than others are, and I can because my product retail price is higher. And that gives more profitability to acquire customers. And if you can't acquire a customer, you won't have a business, as Dan Kennedy says. So you have to acquire them through search engine or paid traffic. But I'm sorry, is that too much?
No, I mean, look, it's a lot. It's a lot to take in. Omnichannel is very different now. It's, there's a lot that you have to kind of look at. There's so many different channels. Where's your customer? How are you talking to your customer? And then there's the fulfillment side and operation. Like, there's a lot to unravel there. And, I'm sure this is a conversation we'll have for many, many more years.
Yeah, no doubt.
But, obviously, I know, you're super busy. I don't want to eat up too much more of your time.
Okay.
Neil, I really appreciated you having you on the show. I'd love to give you the opportunity to let everyone know where they can find out, obviously, more about you and more about Voltage.
Yeah, I mean, if you're looking for an opportunity for freedom, a lifestyle, a business by design, if you're just getting started or you got a brand, Voltage can help you in either one of those directions. We're not a done-for-you service. We are a coaching and mentoring mastermind. We are also a consultancy. But we're not an agency. I know that doesn't sound right to some people's brains, but we actually work more in brand partnership with people. So you need to go through an application process. We're going to determine if we're a good fit, if your product's a good fit, if it has an omni-channel capability. And there's a number of factors we weigh into that. At the same time, at Voltage, DM.com, voltagedigitalmarketing.com, we also are acquiring, as mentioned. So if there's brands doing more than $1 million in EBITDA or net profit between 1 and 3 million, we're looking to acquire those, but they must be omni-channel. So everything I just said today must be a part of your brand in some capacity because we're looking for omni-channel. If it's heavier on Amazon FBA and lighter on the other channels, that's okay because we know we can take and optimize those additional channels. So if you're in one of those three boats, if you're beginning, if you're in the intermediate growth demand and looking for an exit opportunity, or you are looking to exit and wanting to get out of the business and see if someone's interested in buying it, one of those three things matches up with you, then go to voltagedm.com. Let's have a combo.
Love it. Neil, thank you so much for your time. Everyone who tuned in, of course, thank you as well. Please make sure you do the usual rate, review, subscribe, all that fun stuff on whichever podcast platform you prefer, or head over to ecommshow.com to check out all of our previous episodes. But as usual, thank you all for joining us, and we'll see you all next time. Have a good one.
Thank you for tuning in to the Ecomm Show. Head over to ecommshow.com to subscribe on your favorite podcast platform or on the BlueTuskr YouTube channel. The Ecomm Show is brought to you by BlueTuskr, a full-service digital marketing company specifically for e-commerce sellers looking to accelerate their growth. Go to BlueTuskr.com now for more information. Make sure to tune in next week for another amazing episode of The Ecomm Show.